Welcome back. Now, the stocks in Central Europe, in Russia and Africa as well, as it turns out, are some big beneficiaries of the movement of funds away from banks in Europe, primarily due, of course, to the European crisis. Here's a reason why. The problems in Western Europe's banking sector, and that includes everything from brutal haircuts on Greek debt to a bailout for Cyprus to hit big depositors, or the governance scandal at Italy's Monte dei Paschi. All of these have undermined old assumptions about relative stability. An analysis by Reuters indicates that in parts of Central Europe, government efforts to hold down debt, of course, helped economies tip into recession. Foreign currency mortgages have become quite the problem. They're an extra drag on consumer spending. But the MSCI Emerging Europe Financials Index, which includes banks in Russia and Turkey, so far, as it turns out, have held on to the 40% gains they made last year. Key exception, though, these guys, Slovenia, eurozone members, still classified as a frontier market. It is the one notable exception here. It's the only ex-communist country in Europe that did not privatize its major banks. It's now struggling to manage its bad debts and at the same time avoid and avert a bailout. But remember, exception, not the rule. Investors, however, do say that banks in countries like Turkey have already gone through the crisis period and reform, in effect making them a far safer bet. However, it's always possible to find other attractive options on local emerging market exchanges, because these tend to contain large numbers of financial services stock. And remember, we're talking about the BBC model here. You've got banks that always benefit when economies start to take off. You've got beverage companies also tend to benefit quite a bit, and communications. That fits very nicely into that niche. Globally, though, some interesting numbers emerge. Emerging market banks are enjoying a return on equity of anywhere between 17 and 20%. That's well above the average for emerging market companies as a whole. Remember that BBC model? Keep it in mind. This, for banks, is way higher. Now, growth inevitably does come with a couple of risks, especially bad debts. UBS analysts say non-performing loans in emerging market banks are likely to rise in 2013, and that's for the first time in since 2009, with risks in Europe, in the Middle East and Africa. And that includes an expansion into consumer loans. We saw this very strongly in South Africa. Particularly, however, keep a close eye on Russia. Some of the governance issues in Western Europe as well are a very key reminder, though. The banking sector isn't always as transparent as you'd like it to be.